Hey there, and welcome back to Asset Zenith, the place where financial clarity meets strategy, and where we make the world of investing a little less intimidating and a whole lot more empowering. Now, imagine this for a moment. You're on a long journey toward financial freedom. Think of it as a road trip. Stocks are like highways, fast, unpredictable, sometimes thrilling, and occasionally a little dangerous. Bonds? Well, bonds are like the country roads. Slower, calmer, more predictable. They won't give you a wild ride, but they'll get you there steadily. And more importantly, they'll keep you safe during the rough patches. This is the often overlooked beauty of bonds. They're not flashy. They don't dominate the headlines. But in the world of investing, bonds play a vital role. Like the quiet, dependable friend who always shows up when you need them. So, what exactly are bonds? Well, picture this. Instead of borrowing money from a bank, imagine you become the lender. You give your money to a government, a city, or even a large company. In return, they promise to pay you interest at regular intervals and then give you back the full amount when the agreed time is up. That, in essence, is what a bond is. It's a loan, and you're the one doing the lending. Now, there are different flavors of bonds, each with its own unique personality. Government bonds are like the honor students, super reliable and unlikely to disappoint. They're backed by the strength of the national government, making them some of the safest investments out there. Municipal bonds, issued by states or cities, can be appealing too, especially because the interest you earn on them is often tax-free. Think of them as the hometown heroes, stable, local, and beneficial to your community. Corporate bonds are more like ambitious entrepreneurs. They can offer higher returns, but with that comes more risk. After all, not every business succeeds, and if one goes under, it might take your investment with it. And then there are international bonds, the travelers of the group. Investing in them lets you tap into markets around the globe. There's more complexity, of course, foreign currencies, political risk, but also the potential for greater diversification. Now, here's how bonds actually work. Let's say you buy a bond for $1,000. It promises to pay you 5% interest every year. That's $50 annually, every year until the bond matures. Then, when it reaches its maturity date, you get your $1,000 back. Pretty straightforward, right? But what makes bonds really interesting is that you don't have to wait until maturity. You can sell your bond in the market, just like a stock. But here's the catch. The price of your bond might have gone up or down depending on interest rates and how trustworthy the market thinks the borrower is at that moment. So, why should anyone care about bonds in their portfolio? Because they bring balance. If stocks are the engine that powers your growth, bonds are the brakes that keep you from flying off the road. They add stability, especially when the stock market is misbehaving. And let's be honest, that happens more often than we'd like. Bonds can provide a steady, predictable stream of income, which is comforting, particularly during uncertain times. They also help protect your capital. When you're getting closer to retirement, for example, you may not want all your money in riskier assets like stocks. Bonds become your cushion, your protection against life's financial curveballs. And let's talk about diversification. Stocks and bonds don't always move in the same direction. Sometimes, when the stock market falls, bond prices actually rise. That seesaw effect can smooth out the wild ride of investing. Now, it's important to be honest. Bonds aren't without risks. Interest rates are one of the biggest factors. If they go up after you buy a bond, the value of your bond might drop, simply because new bonds being issued now offer higher interest rates, making yours less attractive. Then there's credit risk. What if the issuer, whether it's a company or a government, can't pay you back? That's a risk too, especially with lower-rated bonds. Inflation is another sneaky enemy. If inflation rises faster than the interest your bond pays, you could be losing purchasing power without even realizing it. And of course, there's liquidity, or the ability to sell your bond quickly if you need cash. Some bonds are easy to trade, Others, not so much. So, how do you know if a bond is trustworthy? Well, bond rating agencies come into play here. Think of them like credit score companies, but for bonds. AAA ratings are the gold standard. Anything BBB or above is considered investment grade. Below that, you're entering the world of high-yield or junk bonds. They pay more, but they come with a greater chance of trouble. Now you might be wondering, how much of my portfolio should I put into bonds? It really depends on who you are as an investor. Are you young and eager to grow your wealth quickly? Or are you nearing retirement and prioritizing safety and income? There's an old rule of thumb. Take your age, subtract it from 100, and that's the percentage you should hold in stocks. The rest goes into bonds. So, if you're 40, that means 60% stocks and 40% bonds. But remember, it's just a guideline, not a law. You can also invest in bonds in two ways: individually or through bond funds or ETFs. Buying individual bonds gives you more control. You know exactly how much you'll earn and when you'll be repaid, but it takes more effort. Bond funds or ETFs, on the other hand, give you instant diversification. Instead of picking one or two, you get access to dozens or even hundreds of bonds in a single investment. They're easy, convenient, and a great place to start if you're new to the bond market. So, when do bonds really shine? Usually, it's during stormy weather. When stock markets are dropping, bonds can act like an umbrella. When interest rates fall, bond values often rise. And when investors feel nervous about the economy, they tend to run to the safety of bonds. That's why bonds are a core part of a well-balanced portfolio. They won't make you rich overnight, but they'll help protect the wealth you've worked so hard to build. Think of your portfolio as a symphony. Stocks are the violins, loud, dynamic, passionate. Bonds are the cellos, deep, calming, and grounding. You need both to create harmony. Some investors go with a 60-40 split, 60% stocks, 40% bonds. Others prefer 70-30 or 50-50, depending on their goals and comfort with risk. There's no one-size-fits-all approach, but the key is balance. And here's something to keep in mind. The most experienced investors in the world, pension funds, university endowments, even billionaires, allocate a significant portion of their wealth to bonds. Not because they're exciting, but because they're effective. Because true wealth isn't built on hype or quick wins. It's built on patience, on discipline, and yes, on balance. Bonds may not grab the headlines. They may not double your money in a year, but they will show up, month after month, year after year, quietly doing their job, supporting your growth, protecting your downside, and providing the calm in the storm. So, the next time you look at your investment plan, ask yourself, do I have enough stability here? If the answer is no, it might be time to bring bonds into the picture. Because in the long game of investing, they just might be your secret weapon. Thanks for spending your time with us here at Asset Zenith. If you enjoyed this story and learned something valuable today, be sure to like, subscribe, and leave a comment. We're always here to help you build smarter, invest wiser, and reach your financial zenith, one thoughtful decision at a time. Until next time, stay balanced, stay focused, and as always, keep growing.